Stocks trade firm but ranged as signs of global economic weakness emerge. Healthcare and realty gain while financials drag and mid-caps outperform.
Hindalco arm Novelis posts healthy volume growth and margins and shares a positive outlook, while Shree Cement reports in-line numbers but points to higher margin and capacity-driven revenue growth.
Crude slips to a 3-month low following a sharp jump in U.S. inventories and indications of economic weakness in China. Stocks of refiners and users like paint companies perk up.
A jump in margins drives up Apollo Tyres. Strong business momentum boosts Prestige Estates. Better profitability lifts Zydus Life, and an operational beat props up Prince Pipes. Cummins too gains following robust growth guidance with a favorable sales mix.
Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar. With me, as always, is Pavitra Parekh. So, Pavitra, there is weakness and global cues, which is like putting pressure. But Nifty 50 has been seeing minor gains in a very tight range and maintaining that throughout the trading session today. So let's take a look at the markets at the moment. 19,439 points on Nifty 50, which is just marginally in the green. When we talk about sensex, that too is extremely flat at the moment. Bank Nifty is where the maximum damage is, 0.25% down on that, and some blue chip banking names are the ones which are a drag. But the mid-cap universe, that is the one which is showing a lot more strength and exuberance and is outperforming the market or the key indices by a huge margin and 0.87% up. And that's also having a bearing on the market breadth with advances far more than the declines for the market. But on my screen at the moment, Asian Paints, Adani Ports, BPCL amongst the PSU pack, and some of the pharma names which were doing well yesterday are even showing exuberance today against the overall weakness that we have seen, or tepidness we would call it. ICICI Bank is the top Nifty loser for the day, Pavitra.
All right, so the banks actually have proven to be a bit of a, the problem area for the market, but I wouldn't call this a weak day, maybe just some consolidation after that sharp run-up that we've seen. The global handover also is very strong. We have that big move on crude down, which is helping our own markets, and the broader markets are very excited in trade. Even for the Nifty, from the lows of the day, we've seen a 40-point recovery, and we've held that, so that is encouraging as well. Like Nisha was pointing out, very positive advanced decline over there. You have the crude impact playing out, so HPCL, BPCL, IOC all seeing good moves. The likes of Prince Pipes, Alchem, Prestige, Trent, I could go on, but all of the earnings reactions coming through looking quite good over there. The entire tire pack is up and about in trade because Apollo Tyres posted a very strong set. So it's got the entire pack excited, 6% higher on JK and Apollo both. And a lot of the new age companies that, we've been talking about for the past few days, they're once again just adding on to those gains. So that is interesting to see. Honasa, however, is pulling back a bit. It listed just yesterday at very flat listing, but it is pulling back a little bit today. On the downside, also some reactions coming through, but nothing too sharp as well on that front. But with that, let's actually move on and kickstart the show today, because we did mention that HPCL is one of the big movers. It's up almost 6%. Of course, the crude impact is playing out, but there's a whole host of other factors that are also impacting it. The second quarter earnings largely. So Sonal is here to tell us what is aiding this 6% up move in the stock. Sonal.
Thank you so much for that. Well, 9-day running for HPCL, where it has seen gains, highest level since July as well. Couple of reasons here. The first thing, of course, is the entire oil marketing universe has done well in quarter two. For HPCL as well, it was a beat in terms of numbers. If I look at it, margins came in higher at 8.6%. Profits were higher at 5,100 crore rupees. The GRMs at $13.3 per barrel were higher by around $5 to $6 per barrel, both on a YOY and on a quarter-on-quarter basis. Now, the second trigger for the company now is all the expansion plans. It has been on a capex spree in last 5 years, and now it seems to be reaping those benefits. It will be raising its refinery capacity, which will come on stream soon. One is at the Vizag refinery, where it's 7 million tons per annum, and they are also commissioning the Barmaid refinery, which is also a huge capacity as well. Mumbai refinery has also expanded from 7.5 to 9.5 million tons per annum. They've also commissioned 2 major pipeline projects in the south. They've also commissioned a regasification and storage terminal at Shara, and overall they plan to do a capex of 75,000 crore rupees over the next 5 years. And this, how will it be split? 20 to 25%, 25 to 30% of this will be in renewables, 20 to 25% in refining space, and balance on marketing. So they are looking at diversifying their current product portfolio as well. The third reason is they have actually put out, or they have commissioned, a wholly owned subsidiary for their green businesses, where they will be foraying into renewables, EVs, there's hydrogen segments, and crude to chemicals as well. And the last one is that they have spoken about lubricants demerger. It happened back in Q4 FY23. There's some update on that, where the company says they are awaiting certain approvals coming in from the government of India. They are looking on either listing it separately or actually looking at a strategic partner as well. So some value unlocking is what they are planning in the lubricants business. On the back of all this, the brokerages, they are quite positive. Nomura has raised the EBITDA estimates by 3% for FY25, 8% for FY26 on higher refining margins of the company. ICICI Securities has increased the FY24 estimates by 122% and FY25 by 17% versus previous estimates. The thing to watch out for the entire universe would be the elections, because that could pose some threat to their marketing margins. But for now, looking good for HPCL.
All right, Sonal, thanks so much for getting us all those important details on what's really triggering euphoria in HPCL. Moving on then, financial services is the favored sector for leading private capital market managers like Renuka Ramnath and S. Srinivasan. And speaking to Lata Venkatesh of CNBC-TV18, they also highlight other sectors and themes that they find value in. Listen in.
I would say financial services is an evergreen, attractive.
And an old love for you.
Yeah, and an old love as well. And, you know, if I look at my own portfolio, if I look at the runway for growth of those companies, the way we are able to use technology to understand our customers better, manage our risks
fintechs
better.
would it be?
Deploying technology in your core business. You know, sometimes fintech gives a sense that everything is only tech and there is no physical presence. I think still a physical reach, having branches, having touch points with the customer is an important one. But the penetration levels is so low and the need is so high. The entrepreneurship is so high in the country, whether it is SME financing or microfinance or housing
All finance
financing
banks.
or personal credits. The growth seems immense for disciplined company. I'm not talking about hubris. It is very, very careful risk management, great deployment of technology, measured growth, well-capitalized balance sheet. It is an endless growth journey. And then there are, of course, other attractive sectors like healthcare. There is domestic consumer, done sensibly, is a very attractive sector. Pharmaceutical.
Your best sector.
Yeah.
Well, financial services, obviously, because it's not, you know, we can't have enough of it in the country. And you can play it in very many ways. The second, of course, is, you know, from our perspective, we are playing, let's say, if you look at Digital India as a theme, because we manage multiple strategies, we are playing the Digital India through who's going to put the infrastructure for Digital India to really thrive. And therefore, we have a specific data center fund, which is building out data centers. And with the advent of 5G and AI, the data center demand is likely to explode. We are also providing much needed capital for consolidation in industry. As you know, the banks are not permitted to provide consolidation financing.
You're not saying realty. I thought you would say that first.
I'm going to come to that. So I'm also playing the domestic consumption story because, you know, the residential real estate market is doing very well, and we continue to sort of put very significant capital. It has great multiplier effect in the economy. So we are playing these three themes through three different pools of capital, and I think it's an interesting and sweet spot to be in.
Let me try what do you call a rapid fire. One question only. So please give me a monosyllabic answer.
Okay.
By when do you think we will have a new high in the market?
Post-elections.
Okay. You?
2024 May.
Okay. Okay, that's excellent.
All right, so that's an interesting conversation coming in from some of the fund managers there. And you can catch that entire interview and conversation tonight at 7 p.m. only on CNBC TV18. All right, moving on then, SIP inflows have been steadily rising, with flows in the month of September hitting a record high of 16,000 crore rupees. And as investors' awareness increases in the market, well, the share of SIP contribution via the direct plan is also rising. In fact, Pavitra has jumped across to the wall with more data on this. Tell us, Pavitra.
So we've been talking about the rise of the SIP figure, and the chart will come up for you on what it's looked like for the past few months. For the month of September, it came in at a fresh record over 16,000 crores, and there was huge celebration. But there is more positive news as well, because within SIP investing, the contribution via direct plans has been moving up steadily. So take a look at this. In April, we had 77%, which was via the regular plan, and 23% via direct. This has improved all the way up until now, when in September you have 74% via the regular plan and 26% via the direct plan. Now, why am I saying this is a positive? Because investing via the direct plan means that the investor is putting in money directly with the mutual fund. So the expense on the part of the investor is lower, because you're not paying any intermediary, right? Now, because of this, because the lower expense is there, it also shows up as a higher return for the investor. Of course, if you look at the overall chart right now, it is still dominated quite heavily by the regular plan. For the April to September period, if I take a look at an average, it is around 76% for the regular plan, 24% for the direct. But it is still so encouraging to see that the direct contribution has been going up month after month. And I just see it as investors becoming more savvy and understanding that it is beneficial to invest directly, cut your costs, and up your returns.
All right, very interesting data there. Thanks, Pavitra. And also, Nilesh had some interesting, name for SIPs as well. And yes, so at the time of Diwali, maximize on your investments. In fact, my colleague Prashant also discussed the trend of rising SIP investments with noted investor Vijay Kedia, who believes that the SIP revolution is just about beginning.
किधर पीक पे भाई 16,000 करोड़ रुपया महीने का आप आता है, 30 दिन महीने में होते हैं, 500 करोड़ रुपया डेली का आता है। मोटा मोटी आप देखो, शेयर बाजार के समंदर में 500 करोड़ रुपया ड्रॉप भी नहीं है। वो हम लोगों ने, चूंकि ये नई नई शुरुआत हुई है, ठीक है, साल डेढ़ साल पहले या 2-3 साल पहले 7-8 हज़ार करोड़ ही होगा, अभी ये 16,000 करोड़ है। मेरे को ऐसे लगता है कि ये इतना बड़ा एक फैशन और ट्रेंड, और ये इतना बड़ा एक रेवोल्यूशन हो रहा है इंडियन कैपिटल मार्केट में। इफ़ आई एम नॉट रॉन्ग, ये 16,000 करोड़ रुपये डेली का आएगा। इसमें 5 साल लगे, 7 साल लगे, ये मेरे को नहीं मालूम है। 500 करोड़ रुपया क्या है यार, कुछ भी नहीं है 500 करोड़ रुपया, अभी तो ये शुरुआत है भाई ये।
All right, some interesting thoughts there coming in. And with that, we'll slip into a short breather on Business Lounge. But more news and updates on the other side. Don't go anywhere.
Welcome back. You're still tuned into Business Lunch, and let's now focus on online gaming companies, because sources tell us that government agencies are closely monitoring the money movement that takes place through online gaming companies, as the government has noted several cases of tax evasion by some of these. So Timsi is here with more details on this. Timsi, what are you picking up?
Well, that's right. What sources are indicating to CNBC TV18 that government agencies including ED, IT and GST departments are currently closely analyzing money movement via online gaming companies. These agencies are currently on high alert for possibility of tax evasion, terror financing and money laundering via these online gaming companies. Meanwhile, government has conducted an internal analysis on the sector which shows that there is a high possibility that online gaming companies are being used to launder money. Also, the analysis hints at the fact that online gaming companies restructured themselves to evade GST and income tax. The analysis also finds that the gaming companies may be using offshore subsidiaries to evade taxes while they continue to operate in India. In some cases, online gaming companies may have also restructured to move ownership abroad, and there have been instances where cosmetic changes in the names of the games have been made to enable money laundering. So let's see what happens finally, what exactly it is that this analysis is hinting at, and whether this means more action by ED, IT and GST department. Back to you.
All right. Thanks for that, Tim C. Moving on to some important commentary. Earlier, my colleague Nigel D'Souza spoke to Amit Chandra, the chairperson of Bain Capital, to really discuss emerging opportunities in India as well as the trajectory of private equity inflows. Listen in.
We're probably, I would hazard a guess, even though we are not venture capital investors in India, we are close to bottoming out. You'll see good, solid companies emerge from this winter, and you'll begin to see the investors getting refocused on them, much like what happened in the, out of the growth equity crisis. I think that's great. You'll also see new entrepreneurs, getting focused on new opportunities, and then as confidence comes back in, you'll see the industry beginning to get back onto a growth path again. If you look at the 5-year chart of private equity flows in India, the line is still upwards, sloping. It's just that we had a 2-year blip because of, turbocharged steroidal growth in some segments of the market. But otherwise, I think we are still a very, very positive structural story.
All right, that is the word coming in from Bain Capital. But with that, we are going to get into a short break. On the other side, we have lots more news and updates for you. Stay tuned for that.